Yo, what is up, guys? Hope you're doing well. Hope you're having a great day. Hope you all are well wherever you are in the world. I wanted to make this video for you guys today because I had a lot of things in my mind and some really positive things that I wanted to share with you guys today. Now, I know in my previous video in 2020, a long time ago, I talked about things that you can do or things that you can invest in to actually keep up as businesses are going down and people are losing their jobs. And in this video, I wanted to show you and explain to you guys how you can actually use different types of asset classes or investing in different asset classes. So regardless of what happens in the economy, whether you lose your job or things go south, your assets go down in value, investments go down in value. These are some of the things that you can do to actually protect yourself from any kind of market downturn in the economy or your investments. So things that people can do, as previous videos I stated that central banks all over the world are printing a ton of money. Now, what does that mean for your dollar value or your currency value? It means that it is going to be depreciating, and the more it depreciates, the more that your purchasing power, meaning whenever you go out to buy stuff, it will be significantly less than what it was, let's say, 3 years ago, 4 years ago, So it's very important to be investing in things that keep up with the pace of inflation so you don't lose your currency value in terms of its purchasing power. Now, I know it's a lot to take in, so I actually made basically just a quick picture here. It's from another YouTube video. By the way, I just got a new TV. I don't know if you guys like it. It's so I just took a quick screenshot of something that I found online. And you can see that it has 5 categories. I'm not sure if you can see it, but basically it's equity, fixed income, cash, real estate, and gold or commodities. Now, why are these asset classes very significant? Why are they very important? Because each one has their own unique feature. Now, let's start off with the first one, which is equity. Now, what is equity? If you've seen my videos in 2018, it talks about equity and how you can diversify into different stocks. So it's basically diversification into different companies like Apple, Amazon, Google, all these, Microsoft, all these big blue chip companies. And you want to have, some stocks in there that are high cap, low cap, mid cap, so it gives room for growth. Low cap, it's more risky, but you can actually make more money. But again, there is downside, so it's important to have a fixed income in there as well in the equity fund. There's a lot of things that you can do with an equity fund as well. There's also things like ETFs, which is basically it basically tracks an index like the S&P 500, Dow Jones, etc. You also have the index funds. And there's a lot of funds that you can go into. It doesn't even have to be invested in your country. It could be in other countries, so you can take advantage of the currency fluctuations. So, for example, you're invested in U.S. companies. You're in Canada, for example, you wouldn't get paid in Canadian dollars. You get paid in U.S. dollars. So, let's say the company gives you a dividend distribution, you'd receive that in their respective currency, which means it would be good because you get more. So that's one part that you can do to diversify your portfolio. It's very important to have that, so you can in case something goes up, something goes down, you have that balance. That's why it's called a basket of companies in the fund. So if one goes up, one goes down, it averages out. So another one is, again, fixed income. So those would be like bonds, corporate bonds, fixed income bonds, all those things. So basically, it's just like you're issuing credit to a company. So it can be in an investment in, for example, the bank or an insurance company. You can invest in fixed income funds where it gives you a very variable but conservative rate of return. So the good thing with that is that, companies, they have 2 things that they do to raise capital. They do it through equities, and they also do it from fixed income, which is debt. And by debt, they basically borrow money from investors, but investors in return, they ask for a yield. Now that yield could be variable, or it could be fixed depending on the company and how much assets they have under management, their expenses, etc., etc., etc. But the good thing with this is very low risk because companies usually pay out pay out the bondholders before anybody else, before dividends, etc. So that's the very good asset class. It's also lower volatility, but very conservative returns. Lower volatility meaning it doesn't go up and down like crazy. It's lower volatility but conservative returns. So that's what it would be. And it could be, again, it could be corporate bonds, it could be institutional bonds, it could be whatever company basically needs money to fund their operations for whatever they need to do with the money. So that would be bonds. You can also have cash. Cash is basically like money basically money in a savings account. It's very, sometimes you don't know what asset class would go up or go down. So sometimes it's very important to stay in cash, put your money in a checking account. So for example, if there is a huge dip in the market, whether it be any kind of market, real estate, whether it be bonds or equities, like I talked about before, you can have cash on the side to actually buy during that time. You also want to have cash in case let's say there's uncertainty in whatever market there is. We don't know if it's going to go up or down, and there's a lot of people that don't know, if it's going to go, in what direction. Having cash on hand is just very safe. If you need money for food, or you need money for shelter, or you're over invested in the market and the market is going down, that cash is a form of an asset class that can protect you from just basic things. So cash is important. Real estate. Now, real estate, I've had a lot of real estate videos in my channel, mostly about real estate in the Philippines. But real estate in general, it's pretty straightforward. It just involves basically buying real estate, and you can make money in two ways, which is through the capital appreciation, which is basically the price of the real estate property going up, and you can also make money from cash flows. So let's say you want to rent out your property. After all expenses, you would receive a monthly income stream. So this is actually one of the most, I think, personally, in my opinion, a very important asset to have in your portfolio, because with for example, fixed income and equities, there's a 50% chance it can go up, and there's a 50% chance it can go down. So having real estate in your portfolio is actually quite interesting, because typically real estate actually goes up over time, regardless of where it is. Obviously, it needs to be in a good location where it has access to everything, it's accessible to grocery stores, shops, etc., etc., etc. But the two streams that you can make from real estate is it just keeps going up. So again, the capital appreciation and the monthly income streams from the rental income, right? So those things just keep on going up as time goes on, especially as central banks print more money. Rents tend to go up. Real estate prices tend to go up. If you've seen in the West, it's just been going crazy. Canada, US, the real estate prices have just been going crazy. I know that in the GTA, it has just soared so much. I think in the past year, it's increased more than 34% from a study that I saw a few months ago. It's crazy. So it's important to have this. Although there is a lot of barriers to entry, obviously you need a lot of capital. So for people who do have money, or if you're doing maybe syndicates, which you look into that first, basically going into a group setting. I know Grant Cardone talks a lot about syndications, where he basically borrows people's money, and then whatever he makes on that, he shares on the profits. So that's another form of real estate that you can use. And then another one would be gold. I mean, if you look, gold and commodities, if you look at the recent events going on right now, like in the Ukraine-Russian war, a lot of people are taking money out of other asset classes and they're putting it into gold and commodities, because those things are actually the safe havens, as they say. Basically, whenever there's war or uncertainty in the market, people usually put their money into safe things like gold, and they also put into things like oil, and they also put into things like soybeans, rice, orange juice. So as you know, I think Russia is one of the second largest importer of oil. So I think oil actually went up. Yeah, actually oil went up a lot the past few weeks, but I think it's going down right now. But commodities are very important, because people need these things. For oil, oil is needed in pretty much all aspects of our lives, gasoline, etc. So it's important to have all these in your portfolio because the world is crazy. You know, we don't know what's going to happen, and you know, one asset class can go down 50% in like a few weeks. Like, I don't know, in March 2020, you can see that the market actually tanked so much that, you know, if you were in those asset classes like equities and equity stocks, cryptocurrencies, they've actually went down a lot. So by having something in your portfolio, like for example, cash, then you would be able to buy the dip, and then you'd be able to ride the upswing of the market. Now, crypto is also one. It's not here, but cryptocurrency is the wild, wild west. It's a, you know, I think it's a very important asset class going into the future. And I'll also look into that because, you know, it is most of it is decentralized, meaning the demand and the supply, and basically how many buyers and sellers determine the price of the asset. So it could be a good thing because, you know, some other asset classes are highly manipulated. Like for example, stocks. There are times where it could be manipulated by, depending on how many people own the shares, right? With crypto, it's basically dependent on how many people think the asset is valuable. So if more people think the asset is valuable, then the value will remain at how many people believe it's valuable by the amount of buyers and the amount of people who are holding the asset class. Whereas if there's a huge sell-off in crypto, people don't believe that the project is good enough or it's really bad, then that will determine the price of the asset. So that's like kind of a basic understanding of it, but there's obviously more to it. I'm not going to get into this video, but the main point of this video that I wanted to discuss is it's important to have, you know, if you can afford, it's important to have all of these in your portfolio. So regardless of what happens in the economy, you are financially protected from anything that goes on. So I hope you guys enjoyed this video. Just a little bit of a rundown that I wanted to share with you guys. I will be making more videos like this. I just kind of thought about this the other day, and I know I've been touching a lot about diversification in my past videos, but I wanted to elaborate in detail and why it's so important, especially during these times where, you know, a lot of things are going down and under, especially in the economy. It's important to protect yourself financially because you are the only person that can protect yourself. And it's important to have knowledge of these things so you can protect yourself financially regardless of what happens in the economy. So I hope you guys enjoyed this video, and I will see you in the next one. Take care. Have a great day. Bye.